Now, look, I ignored my entire ARCC position last month. Now, it's not because I forgot about it, it's simply because I was focused on something that really changed my perspective on the so called dividend darling Aries Capital. Now, look, where everyone's chasing Aries Capital and the 9.5% yield, I think they're really missing out on some of what I think is some of the shocking dividend coverage here with ARCC that can really devastate the income stream. So, look, this is what I found. There's a BDC out there called Blackstone Secured Lending Fund, BXSL, and it's delivering, in my mind, what I think is much better value, high yield, and perhaps most importantly, a really nice sustainable coverage that ARCC simply can't match. I'm talking about BXSL. There's one metric here, I think, that reveals why this switch is not just smart, it's going to be absolutely essential for most serious dividend investors. So, why is ARCC not the best at the moment? Well, let's talk about what I think is the ARCC myth that's costing investors some real money now. Everyone loves Aries Capital. It's big, it's been around for a long time, and it's got a fantastic 9.5% yield, and it looks absolutely delicious. But here's the big problem, okay? Now, look, following the crowd, size doesn't always equal safety. Popularity doesn't always guarantee performance now. So the first real red flag here, I think, is hiding in plain sight. Dividend coverage ARCC has been weakening for years. Now, look, when I really dug into the numbers, I began to notice that the net investment income really doesn't cover much more than the distributions. So we're talking about coverage ratios, I think, are hovering dangerously close to 1.0. Now, this means they're essentially paying out pretty much everything that they earn. Now, this is not sustainable dividend investing, my friends. It's just simply living paycheck to paycheck, but at a corporate level. Okay, but I think it gets worse. ARCC's net asset value growth has been absolutely stagnant over the past several years. Now, while the market's been rewarding growth and quality, ARCC's NAV has been stuck pretty much in neutral. Now, this tells us that the underlying business is not really creating that much real value for shareholders. You're not just, getting a dividend. You're sort of slowly watching your principals really not much grow. It's sort of eroding essentially because of inflation and the opportunity costs that you've lost by not investing in other companies. Now, I think the institutional ownership here is creating a false sense of security, and everyone's thinking, well, look, if the big money is in ARCC, then it must be safe. But hey, look, institutional investors, they are not dividend focused like we are. They're playing a very different game and with very different time frames. And just because BlackRock owns a whole pile of shares, it doesn't mean that this is the right choice for you and your income. Okay, so let's also look at the fee structure that's, busily eating into our returns. ARCC's management fees and incentive fees add up to a reasonable drag on performance. And I think if you're already looking at coverage ratios that are not the best, then every basis point of fees is going to matter. Now, these fees and the costs, they compound over time, and it turns what looks like a 9.5% yield into something much less attractive overall. So let's get into some of the actual numbers here that really made me change my decision here. ARCC's most recent quarter showed net interest investment income of 48 cents per share against distributions of 47 cents per share. So this is a coverage ratio of 1.02. Now, compare that to what I found with BXSL, and you'll begin to understand, I think, about why I made the switch. And this is exactly the feeling that I had when I started looking elsewhere for my BDC allocations. So look, Blackstone Secured Lending Fund, BXSL. I think this is the BDC that's really been flying under the radar recently, while it delivers exactly what dividend investors actually want and need. Sustainable coverage, backed by real coverage and good yields and a growing net asset value. So let's start with the coverage comparison and let's look at what this changes. So ARCC's is scoping by with 1.02 times coverage. BXSL is delivering coverage ratios around 1.15. Now, it's not sounding like a huge difference, but in the BDC world, this extra cushion, it is essentially the difference between a dividend that survives market turbulence and one that's going to get cut when the time comes and the going gets tough. So look, the net asset value trends, I think this tells us an even more compelling story. So over the last several years, ARCC's NAV has been essentially flat, but BXSL has shown consistent growth in the book value per share. Now, this isn't just about the current dividend. This is about building your wealth and value of your investment over time. Now, when your NAV is growing, you're getting a good total return that compounds your income strategy. So this is also where it gets even more interesting. BXSL's yielding over 10%, which is already higher than ARC's 9.5%. But unlike ARCC, this yield at BXSL is backed by superior fundamentals. Now, the portfolio quality in BXSL reflects Blackstone's institutional lending expertise. So these are not simply higher yields, they're better secured yields. So Blackstone's lending platform gives BXSL access to a great deal flow that many other smaller BDCs can't really match. So we're talking about access to great first lien secured loans to established middle market companies, often with equity kickers included that can actually provide an additional upside. Now, this is not speculation, this is institutional quality lending with retail accessibility. So the fee structure, yeah, it's eye-opening. And I think while both BDCs charge management fees, BXSL's incentive fee structure is more aligned with shareholder interests. And they've structured the fees to reward actual performance, not just simply gathering more assets. So when management is making money, they will only make the money when we make money as shareholders. And this really aligns what they're doing and how they do it with our perspective for long-term returns. Now, I know what you're thinking. BXSL is newer. Doesn't that mean higher risk? But here's the thing. Look, newer doesn't automatically mean riskier, particularly when you're backed by one of the world's largest alternative asset managers. So look, Blackstone has been in the lending business for decades. BXSL is simply giving you access to that expertise in a permanent capital vehicle designed specifically for income investors. So the risk-adjusted returns, I think they favour BXSL in pretty much every meaningful category. Lower volatility, higher yield, better coverage, growing NAV. This isn't even close when you begin to look at the numbers objectively. Now, ARCC, yeah, they got brand recognition, but BXSL has the fundamentals that I think actually matter when it comes to dividend sustainability. Okay, so what about this big elephant in the room? That is liquidity. Now, yes, ARCC trades at greater volume. This makes it easier to enter and exit. But look, here's my take. If you're buying BDCs for quick trades, I think you're missing the point entirely. You should be holding these for long-term income investments. So the slight liquidity advantage of ARCC doesn't really offset, in my mind, the fundamental disadvantages of dividend coverage, growth, and yield. Now, I think it's also important to look at the portfolio composition at BXSL. It's more defensive. They focus on senior secured loans with really strong collateral coverage. ARCC has more exposure to subordinated debt and other equity investments. And in the uncertain economic times like we have today, I think the seniority in the capital structure provides a very crucial downside protection for BXSL. Now, what really convinced me, though, was the management team's track record during the 2022 credit stress. And look, a lot of BDCs saw their portfolios deteriorate, but BXSL maintained strong credit metrics and actually grew the NAV per share. And this is the type of performance that I think you want to see when markets get choppy. So, yeah, the dividend sustainability at BXSL is not just about current coverage, it's about the trajectory of coverage. And their earnings power is growing, their portfolio quality is improving, and their fee structure rewards long-term value creation. ARCC, just feels like it's managing the overall decline and the quality of the portfolio rather than building for growth at the moment. And ARCC, don't get me wrong, it's done well over the decades. But ultimately, this is my investment decision. So when I began to put all of this together, the comparison metrics decision became pretty clear. BXSL, great dividend coverage, comparable at least to ARCC's coverage. It's not just a number. There's the difference for me between sleeping well at night and worrying about dividend cuts. I love the NAV growth trajectory here. BXSL has been slowly growing over the last several years, while ARCC has stayed relatively flat. So this is my portfolio allocation strategy with BXSL. I'm treating this now as a core BDC holding rather than just a speculative play. I'm getting more yield from the same dollars invested, and I think with better, stronger fundamental backing with the first lien loans. So the transition's taken several weeks as I leveraged and dollar cost averaged into BXSL in the last several months and over the last several weeks. So who should consider switching? I think if you're a long-term buy and hold dividend investor looking for sustainable income, then it will make sense. But if you're trading BDCs for quick gains or you need more liquidity for your positions, then ARCC's higher trading volume may serve you better. But a serious income-focused investor, I don't think you can go too far wrong with BXSL. Now, it's also important to look at the timeline here, and I think it's, taught me quite a bit. I think, I've held ARCC for a while here, and it's important to recognize that popular doesn't mean best. And there are many other opportunities out there that are flying a little bit under the radar while people chase the big well-known names. So look, my subscribers, my friends, you're going to see a bit more deep dive BDC coverage here. I'm going through a complete breakdown of the BDC sector. I'm going to be looking at dividend safety, growth potential, and I promise you BXSL is not going to be the only surprise on this list. So like and subscribe. We'll get into this soon. So yes, BXSL, it has good coverage. It has good dividend levels and yields. It has a good quality portfolio. So while everyone else is piling into ARCC and chasing the brand name, I think the smart investors are finding better opportunities in investments like BXSL. So look, this is not about being contrarian just for the sake of it. This is about following the data and making better investment and income decisions. When you can get more yield, more coverage, more book value growth, I think the choice becomes fairly obvious, right? So subscribe today, my friends, for more deep dive BDC analysis. I'm going to cut through some of that market noise. I'm going to focus on what matters for you and your dividend income. Check out my other videos such as main versus FDUS or FIDUS comparison videos as well. Just have a look at how I replace my BDC investments